ways to build wealth through investing, each focusing on a distinct strategy or principle for getting rich over time. Building wealth through investing involves a variety of strategies, each with its own principles, risks, and potential rewards. Whether through long-term stock market investing, real estate, dividend stocks, or emerging assets like cryptocurrencies, investors can tailor their approach to fit their goals and risk tolerance. Key concepts such as diversification, dollar cost averaging, and reinvesting earnings underpin these methods, helping to maximize growth while managing risk. Understanding these distinct strategies provides a comprehensive foundation for anyone seeking to grow their financial assets and achieve lasting wealth over time. Long-term stock market investing, harnessing the power of compound growth. One of the most proven paths to wealth is investing consistently in the stock market over the long term. By purchasing shares of high-quality companies or diversified index funds and holding them for years or decades, investors benefit from compound growth, earning returns not only on their initial investment but also on the accumulated gain. The key is patience and discipline to ride out market volatility and economic downturns. Real estate investing, building wealth through property ownership. Investing in real estate offers multiple avenues for wealth creation, including rental income, property appreciation, and tax advantages. Rental properties generate steady cash flow, which can be reinvested to acquire more assets or pay down debt. Meanwhile, property values tend to rise over time, providing capital appreciation. Strategic approaches like house flipping can accelerate returns but require market knowledge and effort. Additionally, leveraging financing amplifies purchasing power, enabling investors to control more assets with less capital. Investing in dividend stocks, creating a passive income stream. Dividend investing focuses on acquiring shares in companies that regularly distribute a portion of their profits to shareholders. These dividends provide a reliable, often growing income stream that can supplement or eventually replace earned income. Companies with a story of consistent dividend payments and increases tend to be financially stable, making them attractive for conservative investors. Reinvesting dividends through a dividend reinvestment plan further accelerates portfolio growth while compounding. Investing in growth stocks, capitalizing on high potential companies. Growth investing targets companies with strong earnings growth potential, often emerging industries such as technology or biotechnology. These companies may reinvest profits into research and development rather than paying dividends, focusing instead on expanding market share and innovation. Growth stocks tend to be more volatile and riskier, but offer higher upside potential compared to established dividend-paying firms. Successful growth investors conduct through fundamental analysis to identify companies with competitive advantages, scalable business models, and strong management teams. Index fund investing, low-cost, diversified exposure to markets. Index fund investing is a passive strategy where investors buy funds tracking broad market indices such as the S&P 500. This approach provides instant diversification across hundreds or thousands of stocks, reducing the risk associated with individual securities. Index funds typically have very low expense ratios, minimizing fees that can erode returns over time. Because these funds mirror market performance, they eliminate the challenge of stock picking and market timing. Investing in cryptocurrencies, high risk, high reward digital assets. Cryptocurrency investing offers an unconventional path to wealth, by buying and holding digital assets like Bitcoin and Ethereum, which operate on blockchain technology. While extremely volatile and speculative, cryptocurrencies have generated significant returns for early adopters. Investors may buy coins as long-term stores of value or use them to participate in decentralized finance and other emerging blockchain applications. Due to regulatory uncertainties and technical complexities, crypto investing demands thorough research and risk management. However, those who understand market cycles and technological trends may find opportunities for exponential wealth growth in this fast evolving space. Venture capital and angel investing. Getting in early on startups. Venture capital or VC and angel investing involve providing capital to early stage startups in exchange for equity. These investments carry high risk as many startups fail, but successful ventures can yield extraordinary returns. Wealthy investors often allocate a portion of their portfolio to VC for diversification and growth potential. This strategy requires access to deal flow, thorough due diligence, and an understanding of market trends and business models. By supporting innovative companies before they go public or get acquired, investors can participate in the next generation of transformative enterprises and achieve outsized gains. Dollar cost averaging, minimizing market timing risks. Dollar cost averaging, or DCA, is a disciplined investment technique where a fixed amount of money is invested at regular intervals regardless of market conditions. This strategy helps mitigate the risks of market timing by purchasing more shares when prices are low and fewer when prices are high, effectively lowering the average cost per share over time. DCA encourages consistent investing habits and reduces emotional reactions to market volatility. Over the long term, this approach can smooth returns and accumulate wealth steadily. Diversification, protecting wealth and reducing risk. Diversification spreads investment across different asset classes, industries, geographic regions, and investment styles to reduce portfolio risk. By avoiding concentration in a single stock or sector, investors protect themselves from severe losses in any one area. A diversified portfolio balances growth potential with risk management, enabling more consistent performance over time. Diversification is a fundamental principle that underpins sustainable wealth accumulation and financial security. Reinvesting earnings and dividends, fueling compound growth. Reinvesting earnings, dividends, and capital gains is a powerful way to accelerate wealth building through compounding. Instead of taking profits or income out of an investment portfolio, investors use those proceeds to purchase additional shares or assets. This reinvestment generates additional earnings in subsequent periods, creating a snowball effect. Over years or decades, even small reinvested amounts can grow significantly, magnifying total returns. Many brokerage platforms also offer automatic reinvestment plans to facilitate this process. Wealth building through investing is a journey that combines patience, discipline, and informed decision making. By leveraging diverse strategies, investors can create robust portfolios that balance growth with risk management. Consistent practices further enhance long-term returns. Ultimately, a well-rounded and adaptable investment approach empowers individuals to build and preserve wealth steadily across market cycles, securing financial independence and future prosperity.